Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, to discuss all the activity and volatility that's been occurring in the market, certainly since the beginning of the year. Steve, no shortage of anything to discuss here. It's great to see you. Welcome back to Trade Talks.
Jill, it's always a pleasure, and no shortage of topics today, for sure.
That is true. And I want to start with VOLQ, like NDX and QQQ. It's showing a volatility term structure that's in backwardation, which is the spot price is higher than the futures. Explain to the audience why this is significant.
Yeah, this to me is very crucial when you're seeing a downdraft like we've been in. Normally, when you look at a futures curve or a volatility term structure, which is basically the same thing, if you plot the implied volatilities over time for all the different expirations, they normally sort of go, you know, bottom left to top right in a curve. That's normal, and in futures terminology, that's called contango. Which is sort of the normal state of affairs. What we've seen is backwardation, which is when the spot contract or the near-term months trade above the outer months. What fascinated me is we really didn't see this in a big way until a couple of sessions ago. And to me, that in volatility terms, it means that there's a supply and demand imbalance for short-term protection. You know, basically, when you're in contango, when you're in that upward sloping curve, supply and demand for protection versus people willing to supply it at a reasonable price, or the market price is in relative balance. When people start to freak out a bit, obviously they clamor for volatility protection, and the market makers, understandably, those who provide the liquidity, market makers, and customers, and otherwise, understandably charge more for that. And so we didn't, to me, it was fascinating that we didn't really see that freak out until really the last couple of sessions, and in a big way this morning, which may be why we've kind of found a level that we're bouncing off of now. Hard to tell, but I consider that I consider it a necessary condition for a bounce when you're in a major correction, but not a sufficient one. It doesn't mean that we're going to bounce just because we've inverted, but it does mean that at least one of the conditions that kind of mean you've reached a tipping point in the selling has occurred.
Right. And then, Steve, I know you're also taking a look at the spread between VOLQ and VXN. Why are you taking a look at that specifically, and what is it an indicator for?
I've become a big fan of this indicator. It's not always the most, it's not necessarily a great tradable indicator. Let me just say that, but I find it a great explanatory indicator. And a lot of times that's just as important to understand what's going on. The difference comes between the way VOLQ and VXN are calculated. VXN uses the VIX methodology, which is basically every strike that has a bid greater than zero enters the calculation. VOLQ is very different, and it centers around the at-money strikes pretty much exclusively. So if you take the difference between the two, you can separate out at-money volatility from the extraneous volatility, from the wings. And what you might see is if you go to an extreme one way or the other, people are either very sanguine that they're not looking for any downside protection relative to at-money, or that they're quite nervous, in which case you'd see the wings trade at big premiums to the at-money. We're sort of in the normal part of the trading range, which again was another one of these signs to me that people are taking this somewhat in stride. I think some of the reason you saw actually the level bounce a little bit is people as we dipped a little bit, people started to try to dip their toe in some of the out of the money calls a little bit, which changed the relationship. People have been looking for downside for a while, even though the absolute level of VOLQ and VIXN had been rising, but it had not been, a major skew change. But this is one of the ways that you can look for skew changes in a fairly mathematical way.
Right. And Steve, when we're in a backwardated environment and we see indicators such as the spread between VOLQ and VIXN, it certainly means that volatility is very expensive right now. So how do you position in this type of environment if you don't have protection on, or if you're looking to perhaps put some on if you expect more volatility, or does this suggest some sort of a bottom is in because it's really expensive right now?
Yeah, this is unfortunately, I hate to say it. I mean, this is the time you don't necessarily, you really, if you're looking for the vol protection now, you kind of a little on the late side. You probably want to be thinking to trade how to trade a little more strategically. I mean, think about it this way. You know, those who sell volatility are selling umbrellas, basically. And, you know, does the price of umbrella, you know, you could have this low price of umbrellas all the time, but think about the guys in New York who used to materialize to sell umbrellas at inflated prices as soon as it started raining. And that's, I think, what you're seeing. What you may want to be thinking about doing is not, you know, it's tempting to short it at high levels, but that can be, you know, just because the level is high, it can always get higher. But I think you may want to be opportunistic in terms of volatility spreads, you know, where you are defining your profit and loss, and taking opportunities perhaps to sell front month, buy outer month if you think this is about to pass. You may want to opportunistically write options against positions if you feel that there's a chance to do so. If you're looking to buy the dip, cash secured put rights are another way to capture the high volatility. These are things that people might want to be thinking about, but realize that we're doing so in a fairly risky time, and the price to use the time to have really gotten into options to mitigate your risk, it's gotten a lot more expensive, so, you know, over the past few sessions.
All right, Steve, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.